In November 2023, Binance agreed to pay $4.316 billion. That is the largest cryptocurrency settlement in U.S. history. Its chief executive officer, Changpeng Zhao, pleaded guilty to Bank Secrecy Act violations and stepped down. On the surface, you might think this is the end of a company, but here is the question that matters. Why would the world's biggest crypto exchange take this deal instead of fighting it? The answer is not about one bad trade or a single mistake. It's about what happens when a company prioritizes growth over compliance and how that choice eventually becomes expensive. This case is about procedure, liability, and the cost of ignoring financial law. By the end, you will understand not just what Binance did wrong, but why the fine was actually inevitable. To understand the settlement, you have to look at Binance's rise. The company launched in 2017 during the crypto boom. The timing was perfect. Bitcoin was surging. Altcoins were proliferating. Traders needed a place to move between them. Binance was fast. The matching engine was built by CZ, who had spent years writing order execution software for Wall Street and trading platforms in Tokyo. Speed was the edge. Simplicity was the product. Low fees were the edge. Global reach was the edge. You could sign up in minutes with no lengthy verification and no gatekeeping. The platform exploded. Within months, Binance was handling massive volume. Within a year, it was the largest crypto exchange by trading volume. But here is the structural problem. It was a global platform operating in a regulatory void. CZ kept operations offshore. There was no clear regulatory home. The company served traders from every jurisdiction, including the United States. That mattered because the United States market is huge. It is where the most capital sits. Binance's own executives estimated 20 to 30% of the company's potential revenue came from American users. That is billions of dollars in incentive. The internal logic was simple: growth first, controls later. Compliance was treated as a drag on scale. To achieve dominance, the company moved fast. It added features. It onboarded users. It worried about the rules afterward. This is standard startup thinking. It works for social media. It works for payment apps. But it does not work for financial platforms. Financial platforms move money. When you move money, the Bank Secrecy Act applies. Know your customer procedures become mandatory. Anti-money laundering controls become mandatory. Suspicious activity reporting becomes mandatory. These are not suggestions. They are federal requirements with criminal penalties. Binance did not implement these controls, not for years. When the company did implement them, it did so selectively. It blocked retail United States users, but it kept high-value clients through workarounds. It avoided blocking Iranian transactions. It processed money from darknet markets. It allowed Hamas fundraising. The systems that should have caught these patterns were missing entirely. Growth had become the disease. The fine was just the symptom. The allegations came in 3 layers. Layer 1, operating as an unregistered money services business. If you touch US customers and move their money, you need a license. Binance did not have one. They had access to US banking infrastructure. They processed wire transfers and held stablecoin reserves at US banks. But they never registered with FinCEN as a money services business. That was not a gray area. That was a federal crime. Layer 2, weak anti-money laundering controls. The Bank Secrecy Act requires financial platforms to maintain anti-money laundering programs. Know your customer. Verify identities. Monitor transactions for suspicious patterns. File suspicious activity reports when you see them. Binance had none of this, not in the beginning. When they finally implemented Know Your Customer procedures, it was selective. They blocked retail US users. That part worked. But they kept high-value American clients through workarounds. VIP teams would call users offline. They would suggest using virtual private networks to bypass IP geofencing. They would help users open new accounts under offshore entities to hide their actual origin. The system was designed to look compliant while remaining porous. Layer 3, sanctions violations. The US maintains lists of restricted jurisdictions, including Iran, North Korea, Syria, and Crimea. Financial institutions cannot knowingly transact with those regions. Binance processed transactions from Iran. They processed money from Hamas. They processed ransomware payments. They processed cryptocurrency stolen from the Hydra darknet market. The government had the transaction logs. The government had the evidence. Here are the mechanics that mattered. When a platform serves US customers, US law applies. Binance executives understood this. CZ himself said later, and this is on record, that if they had blocked US users from day one, Binance would not have become as large. He said it was better to ask for forgiveness than permission. That's not a mistake. That's a choice. Knowingly, deliberately, with full awareness of the cost. The Department of Justice and the US Treasury's theory was straightforward. Binance saw the revenue opportunity. They knew the rules. They delayed compliance to maximize growth and profits. The evidence came from multiple angles. Compliance records showed no suspicious activity reporting. Not a single suspicious activity report was filed, despite processing more than 100,000 transactions that should have triggered alerts. Internal processes revealed that CZ had instructed compliance staff not to report suspicious activity. Platform design choices, like allowing anonymous coins and privacy features, were intentional gaps. User handling practices showed deliberate circumvention. When a user moved funds from a darknet market to Binance, staff flagged it, told the user to be careful, and then offered them a fresh account to continue. The investigation was not small. The Department of Justice brought criminal charges. FinCEN, the Financial Crimes Enforcement Network, opened a parallel civil action. OFAC, the Office of Foreign Assets Control, investigated sanctions violations. The CFTC looked at derivatives trading. This was not one agency with one concern. This was coordinated, multi-agency pressure. That matters because it compounds leverage. When you face the Department of Justice on one front and the United States Treasury on another, the math changes. The risk compounds. The cost of fighting becomes astronomical. Why the evidence mattered. Binance could not claim ignorance. They could not say the technology was too complex to monitor. CZ had spent years writing matching engines and compliance systems for Wall Street firms. He knew what controls looked like. He knew what systems cost. The company chose not to build them. When they began building controls in 2021, it was only after United States pressure became unavoidable. Even then, they were selective. The evidence showed a pattern, not a mistake, a pattern. This reframed the entire case. It was not about whether crypto regulation was fair or unfair. It was not about whether the rules were clear. It was about whether Binance functioned like a major financial institution, handling billions in daily volume without the controls that major financial institutions must maintain. That is a breach of fiduciary duty to the system itself. That is enabling crime. Once the agencies proved that, the case shifted. It stopped being about whether Binance could fight it. It became about what the settlement would cost. Then came the negotiation over survival. CZ took the deal. In November 2023, he pleaded guilty to a single charge, Bank Secrecy Act conspiracy. It sounds narrow. It is not. A Bank Secrecy Act conspiracy charge means you knew the law applied, you knew your obligations, and you deliberately failed to meet them. There is no accident claim once you plead guilty to that. The penalty structure was broken down across 3 agencies. The Department of Justice extracted $1.8 billion in criminal fines and $2.5 billion in forfeiture, which is $4.3 billion total. The Financial Crimes Enforcement Network added $3.4 billion, the largest fine in its history. The Office of Foreign Assets Control added $968 million, also the largest in its history. The Department of Justice credited $1.8 billion toward the other agencies' penalties. So there is netting. But the cumulative exposure was roughly $9 billion. Binance paid out $4.3 billion. They faced a 5-year monitorship from the Department of the Treasury with access to all systems. They accepted a $150 million suspended penalty. If they breach the agreement, another $150 million is due immediately. CZ resigned as chief executive officer. Walking away from a company you built is a real cost. It signals finality. When the founder steps down, it tells the market this is over. It tells regulators. It tells law enforcement. His personal liability included prison recommendations of up to 36 months, though the actual sentence was ultimately 4 months in custody. Why settle instead of fight? The burden of proof in criminal court is high, but the evidence was overwhelming. Binance had transaction logs, internal emails, and policy memos from CZ instructing compliance not to report suspicious activity. There were offshore account schemes and darknet transaction trails. You do not go to trial when the other side has all of that. Fighting costs tens of millions in legal fees, takes years, and you would probably lose anyway. Then you are liable for all the penalties, plus a criminal conviction. Taking a deal limits the damage. You pay a massive fine, you restructure, you cooperate, and you survive. What Binance gave up beyond cash was leadership continuity, because CZ was considered irreplaceable. It also gave up operational autonomy. For 5 years, the Treasury monitors every major decision, and it gave up reputation. A company that was synonymous with crypto's rise to prominence is now synonymous with its largest criminal prosecution. What the verdict came down to was the weight of evidence. The government proved that Binance knowingly operated without licenses, knowingly failed to implement AML controls, and knowingly processed sanctioned transactions. The defense could not claim the law was unclear or that technology was too complex. Financial institutions do not get to choose which laws apply based on profitability. The financial fallout hit multiple groups. Binance users faced trust shock. The broader crypto industry got a new enforcement benchmark. If the largest exchange could be fined $4.3 billion, no platform was above scrutiny. Investors in crypto projects that relied on Binance for liquidity saw exposure increase. Regulators got their precedent. This was the first time a major crypto platform faced criminal charges. The message was clear. The era of crypto operating in a gray area was over. Market meaning, Binance survived, but its business model had to move closer to traditional financial compliance. Higher operational costs, slower onboarding, fewer anonymity tools. Growth becomes harder. Profit margins compress. The precedent is the most important takeaway. Global crypto firms cannot treat U.S. exposure as optional if they want U.S.-linked business. The cost of ignoring the rules is now quantified. The fine was not just about violations. It forced the largest exchange in crypto to admit that scale does not outrun financial law. When growth beats controls, regulators eventually collect. Subscribe for more breakdowns of major corporate trials. Watch the next case to see how this precedent shapes future crypto prosecutions.